was the first time it even occurred to me that I could go to my financial advisor and say, actually, I don't think that fee's fair. I think you should charge me half, you know?
So welcome to this week's episode of Business Unusual. And today I'm joined by Adrian Hope-Bailie, who's the co-founder of Fynbos Money, real intellectual on the payment systems. I don't know why you're laughing. I mean, you are. And a lucky guy.
A lucky guy.
Welcome to the podcast.
Thank you. Very nice to be here.
Yeah.
Good to join you.
So I don't know where to start, really. I mean, there's so much to speak about. Is it Cape Town? Is it Bitcoin? Is it,
Not Bitcoin.
Not Bitcoin yet. Okay. So maybe you're, a little bit about Fynbos and what you're doing and what you're trying to achieve and maybe the story that leads up to Fynbos.
Sure. I guess there's two sides to that story. There's the what we're doing now, and why we're doing that, and also the origin story, which actually has nothing to do with personal financial management or wealth or anything like that. So maybe starting there, the team, the guys I started the business with, and that's probably part of what comes into the whole luck element, is I met Matt and Don when I was working for a company called Coil, San Francisco-based company. Coil had just sort of spun out of a company called Ripple, also San Francisco-based. So that's probably the start of the luck. I started working for Ripple in around 2015, worked there for almost 4 years. And the CTO at Ripple, a guy called Stefan Thomas, decided he wanted to start his own business. He got some backing from Ripple, and we were going to build out an ecosystem based on technology we had developed within Ripple, a concept called Interledger. It was like the idea was to make money move like information on the internet. So it was the big vision at Ripple was called the Internet of Value, and Interledger was a project we had worked on within Stefan's team. And so what Coil was going to do was build an ecosystem for micropayments based on this technology. So the idea was take this technology and find a use case where it can differentiate from existing payments technologies. And so that was the start of Coil. Now, there was a whole team working under Stefan at Ripple, and a couple of them stayed at Ripple. The bulk of us joined him at Coil, and I was the only one not in the US. So we had been doing some really interesting work with the Bill and Melinda Gates Foundation on mobile money and helping them to build a open source payments clearing system. Sort of a kind of a weird one in retrospect where that fitted in. But they had approached Ripple, learned about what we were doing with Interledger, got really excited about the prospects of that technology for what they were doing. And so we were involved there, consulting into that project, helping with that. So that sort of moved with Stefan and the team, that moved to Coil. And so my mandate from Stefan was, cool, we need a team, and it makes more sense for the team to be based in South Africa that's working on that stuff, because it was all happening here. We were like meeting in places like Arusha and Tanzania and so on. So no point in getting everyone from San Francisco across. Let's do it, based out of South Africa. So Matt and Donovan, two of my co-founders, were working in a little house out the back of Cavendish. I met them through a mutual friend. They were available to do some work. They started out contracting and just helping out on this Gates Foundation stuff. It was a project that ultimately became Moduloop. And yeah, they loved what we were doing. They were really excited about, all the tech we had been building. So they joined me full time. And then pretty soon after, I would say, I think about a year later, I can't remember the exact date, Kieran, who was a friend of theirs and they had worked with for a long time, also joined us. So that was the core team, the four of us. And I guess probably from very early on working with those guys, we knew we wanted to do something together. It's like, we just had a sense that like we worked well together. They're super smart guys. And so, I was talking about Coil in the past tense because Coil wrapped up in 2023. So how Fynbos came about was, Coil was building this whole ecosystem for micropayments. And the big challenge they had was, what's your source of funds? Like if you want to pay someone, where's the money coming from? So you couldn't use a bank account because that couldn't be plugged into this interledger technology. So they had found a few crypto wallets that were interested in experimenting with this, and that was working pretty well. But where they really wanted this technology to take off was in the traditional like web industry. People, building for the indie web, they're like old school indie guys. We were very involved at W3C. I was on that payments working group there for a long time. And a lot of the folks from that world, like the indie web world, were very anti-crypto. Like they were very skeptical, called it a Ponzi scheme. So no comment. So there was this challenge that like to get mainstream adoption of Coil's idea, this micropayments idea and building on Interledger, we needed a source of funds that was just normal money. Like, you put in dollars or euros or whatever the case may be, and that's what you're spending. It doesn't have to be crypto. And so that was what we pitched. We said, look, like we would be keen to build this wallet. Will you give us some funding to do it? And that was the start of Fynbos. So Fynbos, the name Fynbos and why we wanted to sort of brand everything that way was just really a call out for us to where we were from, Cape Town. We love like the whole idea of, we were kind of proudly South African story there. Because actually the product was being built for the US and European markets initially. That's where Coil was very focused. So we had this wallet we were building where we were very dependent on Coil kind of for our distribution. They were the ones out there trying to build this ecosystem. And we had built all the tech, and we were, doing all the hard yards of understanding what licenses we needed in Europe and in the US and partnering and learning lots of expensive lessons about what's needed there. And then, Coil shut down in 2023. And we had this team who we knew were very good at what they did, but now had a product that had no distribution, no real market. So Matt and I spent probably a couple of months trying to find a different use case for the wallet. We even got onto like trading communities, US-based trading communities, guys trading things like Pokemon cards, because we thought maybe there was an edge there where trust was a big issue. And could we like introduce our wallet as a way of building trust in person-to-person payments for these communities? Because we had built a really cool identity verification thing. Like if you open an account on our wallet, you had like a handle. We called it a payment pointer. And that allowed you to link that to other sort of verifiable things like your Twitter handle or your web page or stuff like that. So we had built this way of sort of tying all of that together. So we wanted to go to people and say, cool, if you want to buy a Pokemon card from this guy, you can verify that the wallet you're sending the money to actually belongs to this person. We couldn't pay people to use our wallet. And I think the more we tried, the more desperate we looked, and the more these communities were like, nah, these guys are scammers. We're not interested, So, that was like you hear from a lot of people in sort of startups and entrepreneurship that the most important thing to solve for is distribution. And that was where we were. We had great tech, great product, no distribution without Coil. So we made the decision that we either had to shut down or we had to find something else we as a team could do that could be successful. And we tried a few experiments. One involved Bitcoin. We looked at, there was an interesting opportunity or like idea that some guys were working on to do stable coins, but that they were actually backed by Bitcoin. So the Bitcoin, the treasury, the thing of value behind it was Bitcoin combined with some futures contracts. So you basically, as the price difference between Bitcoin and whatever currency you were representing varied, you had futures contracts to make up the difference. We thought it was pretty interesting and we dug into it a bit, but didn't really see a great opportunity there for us. We tried another idea we looked into was helping South African exporters get paid.
It's a big problem.
And we ended up making good friends with the Turnstay founders, the guys who started Turnstay. They're solving that problem for the hospitality industry. And I think that was the right industry to target. We initially were working with a team called Tunnel, a company called Tunnel, who help exporters do their shipping. And we worked with them to try and help some of their customers get paid. So guys who have these online stores, they're selling stuff mostly to South Africa, but starting to expand offshore. We're really struggling to get paid by those overseas customers because they couldn't offer them the stuff they were used to, like Apple Pay. And so we were playing around with the idea of like, how could we open sort of proxy accounts for them in the US using Stripe. So, the payer in the US was using familiar checkout technology and flows and so on, but the money ultimately could still get back to South Africa. There's definitely an opportunity there. It's not an opportunity that suited our team. We were looking for opportunities with technology leverage, and that was just ops heavy, like low margin. Like, how can you set up a really efficient operational business and just be scaling and churning out? So passed on that one, and then landed on what at the time we just called Fynbos Wealth, because we had our wallet. We sort of said, okay, well, let's build a product called Wealth. And that was, I guess, like a lot of good startup stories, that was us solving our own problem. So a bunch of young guys with, earning decent money and not really having a good idea of what to do with it, how to be managing it. I had followed the traditional route of my first job, I got assigned a financial advisor through the company who paid my salary, right? They gave us benefits. So I had a medical aid and a this and a that and so on. And I didn't look twice at like the fees I was paying or what I was getting and so on. Matt, on the other hand, and Kieran and Don, much smarter than me, they actually knew what they were doing, and they had found their challenge was helping their friends. So they were, putting all of their money into nice low-cost investment options, avoiding fees, keeping things simple. But when they went to, friends who came to them for advice, the process was just too complicated. People were like falling off, and so what we started with was, cool, let's solve that by just building something that helps people understand what to do. And it was kind of a Vitality Money type thing where you earn badges and you pick goals and you decide, these are the things I want to achieve. And we would send you a WhatsApp every month. Hey, like, to stick to your plan, you need to put 5,000 Rand into an emergency fund this month and you need to do this. And people loved it. We had a few hundred people using it within a couple of months, but very few followed through. I don't know if anybody ever followed through for more than a month or two. Eventually they were like, I'm just like, I know you keep telling me what to do, but I don't get to the admin of actually doing it. And so the insight there was the only way this was going to work is if we do it for people. And that led us into a great conversation and ultimately a relationship with our LISPA, an administrator we work with called iTransact. And they allow us then to do the actual buying and selling of the products for people through APIs, so we can still build the experience we all had in mind, but actually add the execution to it. So the ability to, hey, I need to put money in an emergency fund. Great. We will do that for you. We'll take your money. We'll put it into an Alan Gray money market. And when you want it out, we'll sell it and we'll pay you out. And that's what we launched with in November 2024. Yeah. Emergency fund and tax free. And it's kind of gone from there.
I mean, I did some research, and I suppose the thing you're fighting is both people not doing anything, but also the fees of financial advisors for not doing much in terms of adding value.
Yep.
And then, so I was like, okay, I did some research. Your key customers, like someone who's got a degree, who's got a good job. I was like, okay, so how much would someone like that put away on a monthly basis for 30 years, maybe 2,000 Rand? So what's the difference between Fynbos and somebody else just investing alone with Alan Gray through a financial advisor? And the amount was, it was substantial. I think it came out at 2.6 million after 30 years at 2,000 Rand if you go through a broker because of their fees.
And I think the thing that that's missed on the fees. And what I found a useful way to think about it is, it sounds like a small amount when you hear, okay, the difference between, 0.5% and 1%.
Yeah.
It doesn't sound like a lot, 0.5%. Yeah. But if you think, maybe only getting 9-10% return each year, it's a half out of that 9. Or 1% out of that 9. It's not out of 100. It's out of 9. So it's, multiply that effect by 10. It's not that
compounding.
Yeah. And it's sort of like everybody loses actually, because you look at what is the financial advisor or the platform or whoever's earning that fee, what are they getting paid? If you add that up over time, it's not a fortune. But it's the lost gains that really impacts you. So it's the thing the potential to have earned that you've lost. You compound that over time. That's what really kills you.
Yeah. So I think it was like 2.6 if you went through a financial advisor, if you invest 2,000 rand, and 4.2.
Yeah, I mean,
if you just go through Fynbos Money, and it was like 1.6 million difference in what? Doing it yourself versus going through an advisor. And I was like, wow, this is a big problem you're solving.
It is. And the funny thing is, it's not a new one. Like, you look at, there's brands like 10X, Signia, anyone who's come into this industry in the last 10, 15 years has probably been coming in on a low fee sort of pitch. It's just so ingrained, the current model of how all of this stuff works, that, I think there's just so much headroom to fix this and fat currently. And I think where probably the problem is most egregious is in your bigger old sort of legacy institutions, where that's how we've always done it. I saw a guy send us his EAC the other day. I won't name the institution. He was getting a tax-free savings account. He's putting in 36,000 rand lump sum. And by the time he had finished everything and paid the advice fee and the platform fee and whatever, there was less than 34,000 actually going into the investment.
Yeah.
And you're like, that's ridiculous. It's like, what for? Like, a tax-free savings account. Like, what advice are you giving someone once they've decided they want to put money into a tax-free? How can you justify taking 1,000 rand of that as a fee? So there's definitely a place for financial advisors. I think they're very important. I think most people should have one. I think the problem is how billing works, how the structure around incentives and so on is just broken. And it's very hard to see how to fix it other than just build something else and try, chip away over time.
Yeah, it seems like money models are needing to change.
Yeah, and behavior. I think like part of the problem is we see it all the time with the kind of questions we get from customers and on our support. I think too many people still see investing and growing wealth as like almost the same as gambling. It's like, oh, which fund should I pick? Like, which one's going to get me the best return? And it's sort of the way they ask those questions is often, how do I like get an edge? And actually the mentality should be much more about like, how do I just manage this plan? How do I have a plan and goals and the emotional side of it is around like having the resilience to just not touch your investments when the markets are down, for example. And I think that's where financial advisors can add a lot of value, like, stop you doing stupid stuff more than anything. Yeah. But at the moment, the way they bill is, I guess I had this conversation with someone the other day. The challenge as a financial advisor is I've got to make money. I've got to survive and pay my bills and so on. And then there's only so many hours in the day. So if I manage your money and you're a young professional who only has a few thousand rand invested, that percentage isn't actually even earning me enough. So now I've got to sell you insurance or something else to even pay the bills. The percentage really starts to bite later. So I think financial advisors are disadvantaged by the current system, but it's very hard to change because it's just good financial advisors. But it's very hard to change because it's just how everyone else does it. So how do you compete? How do you come in and say, and there's some guys doing it. I mean, there's some financial advisors who are like pushing the flat fee model. Yeah. And it's hard because you're going, hey, like pay me for my time. I'm very qualified professional. I need you to pay me like a few hundred rand at least per hour for my time, So a consult's going to cost you a few $1,000, or go to this guy who charges nothing.
Yeah.
It's like, well, I mean, very hard sales pitch to the customer.
Well, the cost is 1.6 million over 30 years.
But it's like that experiment with the delayed gratification with the kids and the marshmallows. It's like, how do I persuade you that that's true? When the guy on the other side is persuading you that his genius planning or advice abilities is going to earn you even more. And it's the same argument that the guys, active fund managers, would have against passive funds. It's like the fee is justified because we'll outperform the index. The reality is 90% of them don't.
No.
So,
and when I read a lot of books internationally that advised pay someone for their advice up front and don't get sucked into the fees. But that was difficult. So trying to find someone because I spoke to a couple of different brokers and I said, can I just pay you for your advice? And I suppose they weren't used to it. And so the better quality ones are also ingrained into a system.
And that's what I mean. It's like it's hard to change the system from the inside, because look at all your competitors. Unless everyone says, yeah, no, you're right, let's all switch to flat fees, this is better for the industry as a whole. It's really difficult, I think.
Yeah. I mean, you mentioned something else as well that I struggled with a little bit, trying to understand what you're saying. You're saying everybody needs a pat on the back, and part of a financial advisor's goal is to actually give you a pat on the back. I think the other thing you said is when there's shit going on. To stop you from making any reaction to things.
And I think it's like it's taken us a little while, since we launched Fynbos Money and this product and so on. But we've really honed our purpose and our mission down to giving people confidence. And I think that's ultimately part of that is a recognition that money is an emotional subject. It's the numbers are easy. You plug them into an AI or into a spreadsheet or whatever. Working out, scenarios and numbers and stuff that's not that hard. The hard part is the emotions, because everybody thinks about money differently. Everybody comes from a different background about how their family treated money. And, was money a taboo subject? Was it something you spoke about openly? How did your parents earn money? Did they not have money? There's a lot of emotion attached. So I think part of it is it's almost like a coaching role that a good advisor takes there. It's just like the pat on the back is, don't worry, your friend who came to the braai last week and told you you're missing out this huge opportunity because you can double your money if you just, I don't know, whatever. Don't worry.
Can you speak to my children?
He's talking rubbish, and it's that kind of stuff as well. So there's definitely a role there. I guess, where we're coming from with Fynbos is somewhere there's a balance there. I think a lot of people want to do a lot themselves, and the information asymmetry that maybe previously existed here is gone. You can go online, you can find a lot of really good information. You can do your own research, as they say, and come to pretty good conclusions. And then you can go into communities online and ask, questions and say, well, I've come to this conclusion. What do you guys think? And so on. And so you can get 90% of the way there. And then if you go to a financial advisor, you go in aware. You're going in, you're not going in blind. And I think for me personally, and I think for a lot of people, that's what probably was the situation where you ended up with this financial advisor who told you a whole lot of stuff. And that's not to say they didn't tell you a bunch of stuff that was wrong, but you had no idea about how to even decide if it was right or wrong, or what was a good fee. I remember when we first started talking about building Fynbos, and I bounced this idea off friends and family. My father-in-law saying to me, but the fee's negotiable. It was the first time it even occurred to me that I could go to my financial advisor and say, actually, I don't think that fee's fair. I think you should charge me half, and it is. But most people wouldn't even think that, because they don't feel empowered enough. They don't know enough about the industry or how this all works to even push back on that and have that conversation.
Doctor fees as well, lawyer fees, all these service fees.
Absolutely. Yeah. So I think especially when it's like a percentage-based fee, which is hard to quantify. It's just like do I pay you 0.5% or 1%? I don't know. What's the norm? What's the benchmark? What does that mean you actually getting paid? Yeah. Why can't I just pay you a number that I can quantify in my head? how does that compare to what I pay my child's cricket coach or my lawyer or my, it's a number is there some relative number there that I can actually ascribe a value to? And then I know, great, you spent so many hours and you put this great plan together for me. That's got a lot of value. I'm happy to pay for it. But when it's a percent, like, what is that number? I don't know.
So, I mean, you chose a flat fee to charge customers, and obviously it's money up front versus the free advice, and they taking it off. You can't even see it. Was there some challenges with that?
There's huge challenges with that. Look, I think we've definitely made this harder for ourselves than we needed to, and it comes up pretty regularly, like, especially in the beginning. I think we've convinced ourselves now that this can work. In the early days, we're getting customers. A lot of people are happy to sign up and pay the fee and use the platform. I think there are a lot of people out there who are very happy to pay for something if they feel like they're getting value. I think in the early days, we definitely went back and forth on this, and we looked at, we spent a lot of time looking at what's happening all over the world and other businesses in other industries. How are they doing this? And a straight flat fee is pretty unusual. There's a lot. It is. A lot of people blend it. They'll have sort of flat or a minimum or something. But our principle from day one was you paying for access to our platform and what it gives you. And whether you invest R1 million or 100 Rand, you're getting the same thing out of the platform. So why should we charge you differently? So we're charging you for access to the platform. And we believe if we build a great product and a brand, especially if we build something that, like a community that people want to be part of. Like, my dream for this is people associate Fynbos with confidence in their finances and a community of people who are like helpful and, they can talk to someone and not feel like they're being sold at. That's kind of the vision in my head. And I feel like if you're paying a monthly subscription to be part of that, a membership to be part of that, that's a worthwhile thing to pay for, as opposed to comparing it directly to what you get elsewhere. And I'm paying this based on an amount I'm investing or whatever the case may be. It's very much and maybe the answer here is we should actually call it that. It's a membership. You're a member of this Fynbos community, and part of the perk of that membership is you get access to this platform that gives you these products you can use. But really, what you're paying for is to be part of this.
Yeah, so funny. I listened to Davy Root this morning, and he spoke about quite an unbelievable thing. But I think there's 2 million accounts in South Africa for cryptocurrencies, Bitcoin. And it's almost like showing the way how many people are actually interested in investing and their own personal finances. And I think it's a big journey that we're moving towards.
So for us, one of the big motivators in how we built the platform and how we think about it is that we believe. And I say young people, it's hard to, everyone's idea of young people is different.
I'm young.
I'm young. I'm in my 40s and I would consider myself definitely in our target, demographic. But people want to do this stuff themselves because that's how we've grown up. The last 20 years, we've had smartphones and apps, and that's how we do things. If I want something, there's an app for it. That's not a new concept. But also, I think what cryptocurrency did was it made a lot more people think about money, think about, how does money actually work? And I think all the chat around Bitcoin and ICOs and all this stuff that's happened over the last 10 or so years exactly is making people think like, well, how does this stuff actually work? Historically, I just, had a bank account and I earned money and it went in there and then I spent it. But I never really thought about like, why is 1 Rand worth 1 Rand? Or what's possible. So I think one of the cool things with the crypto world is people can experiment and do things without asking for permission. It is like crazy difficult to innovate in fintech if you restrict yourself just to like traditional money and Rails and so on, because you need licenses and you need partnerships with the people who probably consider you competitors, so it's really hard. If you just sit to the side of that and say, well, we'll just build it all with crypto to start and we'll try things, and maybe that's not where we're going to end up ultimately, but you can just, you get out of the block straight away. And there's, I think, a lot of innovation and a lot of expectation from customers now that that's how fintech is going to work. Stuff's going to. We had someone actually on our customer support yesterday who was very cross with us for not rolling features out fast enough. She was asking for something particular, and I said, "Yo, it's on the roadmap. We're planning to roll it out." She said, "Oh, come on, guys, get it we want it, yeah." And fair play. It's like great to have enthusiastic customers like that. But I think that's the expectation. People expect stuff to move.
You said it's crazy hard to do what you've done. Why is that? And how did you overcome that?
I think it's crazy hard to do anything that touches money.
Yeah. Because of the trust or because of the financial risk?
Well, yeah, just the ecosystem. You can't just get up one day and say, cool, I'm going to build this product. Yeah. And then, if you've got the ability to build the tech and find some customers, it just works, because money is, there's a network effects thing. Like, my payments app is useless to me unless you also have it and I can pay you and so on. And as soon as you start doing that, you fall under sort of regulatory umbrellas. So, the regulatory stuff is expensive and hard. So our fifth co-founder joined us when we pivoted into Fynbos Money. He's an old friend of mine who is a licensed financial advisor, and he came on board basically to help us cross that bridge. And without him would be nowhere. And I saw today a message on an investor group I'm on, somebody looking for a licensed key individual to allow their startup to operate as a rep. It's really difficult because you've got there's a licensing side, and then something we learned in the first iteration of Fynbos. So when we were operating in the US and Europe, you kind of look at the licensing or the requirements to get licensed, and it looks like a lot of legal fees, and you're like, cool, we got to do this paperwork and fill this in and so on, and it's expensive. But you can't actually submit any of that paperwork until you've built a whole compliance team. That's the stuff that costs money. That paperwork describes policies you have to have in place, and those policies require people who are doing all sorts of time-consuming work. So before you even think about applying for a license, you've got all this cost that you would have in no other industry. Where if I'm building an app that's purely digital in anything else that's not touching money, like I can launch that tomorrow. So that's the challenge. And how we overcame it was bringing Ben on board, and he's been fantastic. He is planning to join the company full time, actually, as get fully stuck in the next 2 months. He's wrapping up a few things that he's still involved in. I do think I don't have an answer as to how to make it easier, to be honest. I think in South Africa, we've got what they call fintech sandboxes and so on. So there are ways you can go to the regulator, to the SARB, depending on what you're trying to do, and experiment. But it's just a lot harder than anything else. If you want to build a business doing non-fintech stuff, you definitely one less barrier you have to cross. And
having 4 founders and another one joining, how difficult is that?
It's interesting.
And how do you make that work? Because I think, we talk about relationships, how important is financial advisors, but generally relationships with maybe fiduciary bodies. Yeah. But internally, how do you guys get that working?
Because I think we're probably quite an unusual business in that we've always had the ambition to be very successful without getting very big. Okay. I think there's an allure to KPIs like revenue per employee. Like, how can you build a really successful business without just hiring lots of people? And I think so we're not a VC backed startup. We're not like going for this explosive growth where someone's given us lots of money and said, like, get it done in a year or don't do it at all, kind of thing. So we had
the chances of them succeeding goes down. VC
exactly
is the opposite of customer funded or self-funded businesses.
Exactly. And so that was the decision. I mean, we're in a fortunate position that we can fund ourselves, and we've got, some decent runway. And so you can take a very different view on the business and the kind of business you want to build. So I think, from day one, we've wanted to build a business that we want to all work in, that we enjoy working in.
Okay.
And I guess I'm very fortunate that when we started, it was very clear. We said, cool, we're going to start this business. Everyone's going to have an equal share. And Adrian, you're going to be the boss, and Matt, you're going to run product. And, Kieran's drives a lot of our front end stuff, and Donovan is just an absolute machine, back end coder. And we've brought on a couple of people along the way. So we've got an unbelievable team who are all, I think, on the same page in terms of the kind of business we want to build. Okay. And it's not there's no ego. It's not like, okay, cool, I want to have ownership or control of this thing. Yeah. It's, I think by having all the co-founders sort of equally invested in the business, everyone's pulling in the same direction. We have a pretty singular vision about building something that grows at a pace that makes sense. I mean, we want to grow as fast as we can, but not by just throwing money at growth. It's not it's everything we do is quite considered. And it's always thinking about like the long-term effect, which is quite a fortunate place to be in, so you can build a brand, you can care about quality of your branding and marketing and care about things like building a community around what you're doing rather than just chasing sign-up numbers or just chasing, investment numbers. We are completely different to all of our competitors that we don't care about our AUM. We don't care how much assets we have under management because it doesn't have any impact on our bottom line. For us, it's how many customers can we get on board the platform that we make happy enough that they will continue paying their 100 Rand a month. And if you think about the business that way, it's a very different business to a more traditional one in our space.
Yeah, I love the turnover per employee because we use that. When we look at top 500 best managed companies, we look at the revenue per employee because you're looking at how productive people are. And I think with AI, technology, it's about how to get that productivity versus just growth for the sake of growth.
Yeah, absolutely. And I think, we've seen it already, how we use AI internally. We're using it pretty extensively, especially on the product side. And just getting, as you say, better and better at increasing productivity without having to bring in too many, new people. And I think there's a certain optimal size, I think, for a business of ours where you don't start getting the growing pains of somebody who's like, once you're at a sort of a 25, 30 person company, there's, this guy doesn't know what that girl's doing and they're working on something and they're not aware of it. And suddenly everyone goes, you have to put all this effort now into keeping everyone synchronized. So from day one, we've been in office. Like everyone comes into the office every day.
Tech companies.
Yeah.
Is it
was a decision we made as the founders. We're like, cool. It's much more efficient for us to just all be in the same place than to spend a lot of time trying to make sure we synchronizing asynchronously and so on. And there's a lot of flexibility. Guys work from home when they need to, or come in late or go home late or whatever. That's totally fine. I mean, it's a very sort of trusted space, but just having everyone in the office, all sort of, it's the little conversations over lunch and the ad hoc, let me grab you and chat about something that you miss out on. It has its disadvantages. We really struggle to bring people into the business like suppliers, like a contractor. So if we say, cool, we want to contract someone to help us with, I don't know, social media, it's really hard because they're not living the culture with us. They're not like sort of, they're not ingrained and sort of picking all this stuff up through osmosis. So we've had much more success just we had an intern working with us for during his holidays. He's a student in Stellenbosch. So Jack came and did a few months in his last holiday, and he came back now. And we've had some great like stuff he's done for our social media, and he like films content for us. And just having him around is and making that content feels so much more authentic to who we want to be as a brand than if we had gone out and got a professional person and sort of given them a brief and waited for them to, you know, pass it back over the wall and say, well, this is what I come up with. So it does make that harder. Like anything you want to do, by default, you want to do it internally first, because you know it's going to be more on brand and more authentic and tie into the sort of the bigger vision. So yeah, it's very like, it's challenging to find relationships with external people that like can get that and can sort of buy into it and are prepared to put in the time to like know us, if that makes sense. But we're at a sort of stage and a size now where we are having to get better at that.
And I mean, you spoke about your runway and funding. I saw you had like 2,000 customers. That must have been a while ago, or is it around that sort of basis?
No, we're a lot more than that now. We sort of measure on, because we have a free tier and a paid tier.
The free tier is for the tax
free tier. If you sign up for the Roots plan, we call it, you can get an emergency fund and a tax-free savings account. Okay. Your tax-free only has one fund in it, so it's really just like, you want to get started, which is what we always sort of push, like just start. You really like, time is the most important piece of this whole thing. Just get started. So if you only have a few $100 a month, you're not going to pay us $100 a month then for the platform. So just get started, start putting some money in. And our belief is that in time, those people are going to convert. They'll get to a point where they've built up a decent asset base and they're going, well, like Fynbos is by far the best value for me here. They've looked after me for, you know, whatever it is, 5 years, 10 years. Now I want a kids account, or I want an RA, or I want some of the other features that are only available in the paid account. So I'll upgrade. So that's kind of what we're measuring is signups. So signups is by default, we assume your Roots. Yeah. How many of those then take the next step and invest, actually put money in? And so that's our investors. And then of that, how many are now subscribers paying for the platform using paid features? And at my last look, subscription revenue is growing 20% month on month. So it's, you know, the numbers are not like VC gangbuster level, but it's, if we can maintain that, we believe if we do a good job and we keep going the way we're going, like we can hit profitability by end of next year potentially, or even sooner. Okay. And so as soon as you break even and we've raised no funding, like what a great position to be in now. Crazy. to think about like reinvesting then in growth or in new product or whatever. So that's where we want to get to. And the number's small, like by keeping that team small, by, you know, trying to just focus on efficiency, that break-even number is not crazy. We don't need to get to, you know, hundreds of thousands of users. It's like in the tens of thousands. Yeah. And I look at other companies in the industry who have had to raise hundreds of millions to get to profitability. I think we're in a good position there.
Yeah, I read that. I think you said you want to get to 1 million users.
Yeah, well, we when we started, one of the things that we identified was like a big, hairy, audacious goal for us was just get more people using tax-free savings accounts. So obviously Fynbos is much broader than that, but like that was a good leading indicator for us that people are just not doing this right, that the industry is letting them down, because everybody should have a tax-free savings account. So like a no-brainer. If you can afford to be putting money away for the long term and you're not putting it in tax-free, somebody's giving you some bad advice.
And with the end of the financial year coming right now.
Yeah.
So if you don't have it, and I was thinking before this, I was like, geez, I mean, I had all that. I think I've got it with Nedbank, but I mean, if you don't have it, I was thinking about the kids as well.
If
you don't have it, you are just wasting.
It's a huge
whatever your.
The sooner you can
get
into it, the
is.
better. Yeah, the sooner you can get money into it, the better, because the benefit is the long-term benefit. It's like in 20, 30 years' time when you want to take some of that money out and it's all tax-free. Yeah. The longer it's sat there growing, I mean, I forget the exact number. We had quite a nice sort of metric here, but 20 years, let's say, imagine you've been putting consistently, I think your number was 2,000 a month.
Yeah.
You know, you'll look back at 20 years and you'll see how much have I contributed versus how much have I actually got. Like 75% of that is probably going to be growth. And that's all gets taxed if you're not in a tax-free savings account. So if you just, opened a unit trust or something and you were putting money in, and even just doing really well and good for you, you've grown your wealth. As soon as you start cashing that out, you pay tax on it. Like tax-free it's a gift. It's a free gift. Yeah. Don't pay tax. So
don't give you much, this SARS and revenue.
No. Take what you can get.
Exactly. Take what you can get. I mean, RA's help and all those things. This is
the thing is like you can use those all in combination. I think like it's very easy to overcomplicate this stuff. And that's where we're trying to get to. It's like, it's not that complicated, but in some respects, making it too simple for people negates the need to go and get help, right? Yeah, okay. And so there is a lot you can do yourself, and it isn't that hard to understand. And so when you go and sit down with a professional, an advisor, or someone, like I think one of the biggest problems is someone sits down with a financial advisor and just like the wool is very firmly over their eyes. They have no idea. And that's not to say the advisor is necessarily bad or giving them bad advice, but how do they even know? And like that's how I would say for me personally is one of the biggest challenges we want to solve is like, how do we build a population of people who are confident that they actually understand what the hell is going on?
So weird you say this because I was speaking, we did a brunch for our 50 top clients. Mm-hmm. And I was explaining about having your team as experts. What I was saying, when was the last time you went into a shoe shop or, Total Sports, whatever, and you ask the person who's giving you advice how long they've worked there? Maybe they've worked there a week, but you're trusting this guy. And so
you're running a marathon. Oh yes, you look like you need the ASICs.
And so we're not asking some basic questions. And some of the other things is what assets do they have? What's their wealth profile look like? What are they investing in themselves? Is there experience coming from something they're doing themselves, or is it just they're just randomly advising us?
Well, I'm not an expert. I'm definitely not an investor. I would be loath to give anybody advice other than very high level. I can sort of say, well, this is what this is good for. This at the end of the day, you need to plug the numbers in, and everything's very personal. Yeah. And good financial advisors are qualified. Like they're a certified financial planner or some equivalent. So they definitely they know what they're doing and they've got all the tools and so on. The challenge there, though, is even a good financial planner is working within the constraints of what the industry has created for him. Yeah. And a very good financial planner might work in a institution where he can only advise you on products that his institution sells. Yeah. So their funds might all be rubbish. Yeah. But that's all he can advise you to put your money into because that's the constraint he operates in. How many people out there actually understand what a tied advisor is, or that there's a difference between a tied advisor and an independent advisor? And if you go to someone independent, they can shop around for you. They can look at different options. And I think that's what I mean by just educating and giving people confidence that they actually understand. Hey, this guy I'm talking to, he works for this big financial institution. I know he might give me great advice, but the specific funds he recommends might not be the best. And I understand enough to be able to discern that he's telling me to get a tax-free, he's telling me to get an RA, he's telling me how much to put in, he's helped me put a plan together, great. But when he says use this fund for my tax-free, maybe I'll go online and compare that to a couple of others and I'll look at the fees and I'll have the confidence myself to be able to go and do that and say, look, thanks for your advice, thanks for the plan, pay for that, but I actually want to put my tax-free saver here because the fund that I want to put it in is much better. And I understand you couldn't advise me that, but that's what I want to do.
My coach actually was telling us when we're training, I think his best friend was his financial advisor before. And then he did some research. He educated himself and he found out it was like 2.5 or 3% of his RA was coming in as costs, and he worked it out. It was costing him millions and millions, and he changed. And he said to he was one of his best friends, like, hey, how come you're charging me so much?
And he probably said, well, that's just our normal rate.
So I want to pivot quickly, because I think that I suppose my message really is that if you're not doing the tax-free as a minimum, an emergency fund as a minimum, and actually it's free on your platform as well, then you probably
emergency
need your head
first.
tested.
Well, at the risk of giving financial advice, like if you're trying to get your money sorted out, get out of debt to start with. Yeah. There's only a certain debt that is okay, and that's like where you've taken out debt to pay for assets like a house, something that's, appreciating. Then it's worth
cash flow.
Getting the leverage, exactly. But typical consumer debt, like racking up store card debt and whatever to buy clothes and things, that's like, get out of that as quickly as you can, because the interest you pay is always going to be more than any investments you're going to earn. So you first think of it as the inverse, like the debt you're not paying is returns you're getting. Yeah. So get rid of that. And then the emergency fund is just such a misunderstood thing as well. It's because and you can kind of see, again, this comes back to the emotion of it. It's like, why am I putting money into this account that's like not generating any returns? It's just a savings account. This feels so lame, but you need that little buffer. And I mean, the research is very clear. Anyone who has even a small emergency fund, so, the goal is to have 3-6 months worth of expenses. Anyone who has even a small one, their mental health is even better. It takes this whole load off your back that, any little thing that might happen to you today that costs you money, you can handle that. Like, you've got this little fund waiting. And so if you've got that emergency fund in place, now you can feel confident that everything you put in your TFSA or into some discretionary investment is there for the long term. Yeah. If you don't have the emergency fund, you're kind of putting money into the tax-free and you're going like, well, let's hope nothing happens and I have to take this out. But that's not where the position you want to be in for long-term investing, because chances are that moment you do have to take it out, like the markets have crashed or whatever, and then you've gone backwards instead of forwards.
It's that state, right? It's that your state of mind needs to be, I'm doing this for the long term, and then you need to be clear that is the truth, and not that there's a chance.
And the emergency fund helps you do that, right?
Yeah.
So you if you've got the emergency fund in place, then cool, this money is going into my tax-free saver or my RA or whatever. I know I'm never going to have to touch this because my emergency fund will cover me. So that's, those are like the basic steps that we sort of codified into the platform from day one, and sort of that's where things have sort of evolved from.
I signed up yesterday, so there'll be money going in. But, and I'll be encouraging my kids. But, I mean, we spoke a little bit earlier about Ripple and your lucky break in Ripple. And obviously, the people that you're trying to reach are professionals, but they're also probably looking for lucky breaks like you had as well in their careers. Yeah. I mean, do you want to talk us through that lucky break of you, how it transpired and
Yeah, I mean, I've been in the payments industry since probably 2009. I lived in Ireland for a few years after I got married. We came back here just after the economy crashed globally and things were pretty tough there. So we came back and I joined a company in the payments industry. I was a software engineer. And again, I'd call that a lucky break, like getting into payments. It was I wasn't looking for a job in payments. I just was looking for a job. That's where I landed. And it's fascinating, most incredible, fascinating industry, learned a huge amount there. Met some great people. As it turns out, the guy who hired me then ended up being my boss again years later. So he rehired me into a new position. Yeah. And Dion, amazing mentor as well. And then I was working for him and had to give him the bad news that I'd got this offer at Ripple. And how that transpired is I just took an interest in, what was happening online and payments. And it was around like the early days of crypto. My wife likes to tease me that I could have had millions of Bitcoin, but never did because I was too interested in the tech and not enough in getting rich. So I dinkum, I remember having an opportunity to buy some Bitcoin off somebody for next to nothing, and I just had to be able to pay him via PayPal, and I got cold feet and didn't do it. And so I tried mining Bitcoin for a while, but I was just using a laptop, and this is like way, way back. So, there's there's swings and roundabouts in terms of luck, right? Maybe I could have been a Bitcoin gazillionaire, who knows? But I was very interested in like this whole world and payments and crypto. For me, like I said, I was interested in the tech and the payments, and I was fascinated by this idea of like, how could you process payments on these blockchains? And so I joined, mailing lists and got chatting to people, and happened to meet Stefan, the guy I mentioned earlier, the CTO of Ripple, on a mailing list, which was actually someone out of his team at the time, Evan Schwartz. So Evan and I got chatting, and then I, got chatting to Stefan.
List, what is that?
An email mailing list. Yeah, so like literally like an online community, guys, posting, email threads, like pre kind of Reddit. This is sort of same format. So yeah, I mean, I guess the analog today is like be involved in these communities, chat to people, spread your network. You never know. Here I was sitting. I mean, I can picture myself sitting in my office in like near Greenstone Park. It's like near Edenvale in Joburg, late at night. Probably should have been home by then. Replying to some email about, I think, Ripple versus Stellar or some other tech conversation. And they came back and said, that's an interesting idea. And within a week, I was having a online interview and got offered the job. So worked at Ripple for almost 4 years. Worked remotely from Joburg and then Cape Town. And yeah, I think the lucky break there was just all of the doors that have opened from there. And being early at Ripple has had financial benefits, which have enabled us to not have to go raise money for Fynbos, as an example. So a lot of like, these things, and you hear about people trying to build these startup ecosystems. And I think it's that flywheel that they're trying to get going. It's, success breeds success. If you have, a bunch of successful founders, in a place like Cape Town, let's say, they are looking to redeploy the money that they've made. They come from this world, and they don't want to just take their money and go buy a wine farm and sit and get fat. And, they want to fund other startups or start more startups themselves, And so, I think there's definitely opportunity there. In our case, we are not a VC-backed startup, not sort of going for hyper growth. But I think there's room for all of those. There's a whole spectrum of types of businesses you want to build and how they're funded and how they run. And yeah, I think we're very happy with kind of the trajectory we're on. But a lot of it attributed to luck. Luck and networks, relationships.
I was going to say that, for anyone who's young and coming up, startups are a good place to be because you're exposed to a lot. Be an early employee.
I was having this conversation with Matt today. It's funny you say it. We were literally talking about it this morning because we were talking about how great we've had a couple of students working with us in their holidays now. So we had Jack, helping on social media and videos, but we've had 2 engineers as well, Ella and Thomas. So Ella's gone to finish her master's now at UCT, but she was with us through, a couple of good few months, and Thomas is in 3rd year now. They're young, very, very, haven't had a job before. Yeah. And we were talking about, how great it is to get smart people, find really smart people, hire them in. Like anybody can learn to be a programmer or do whatever they need to do. I mean, Matt and Don and Kieran they're not programmers, they're engineers. They all studied engineering. They did some programming at university, but that's sort of like they're smart guys. They just, you learn. And my exact comment to Matt was like, our biggest challenge is getting people to come and work at a startup instead of taking a big fat check at, a bank or something like that. If you're the top of your UCT comp sci class, I'm sure you've got, hundreds of people knocking on the door offering you lots and lots of money. And actually maybe the right thing to do, depending on your personality, is not take the best offer, take the job at the business that looks the most interesting, where you're going to learn the most. Exactly. And who knows? Who knows what'll come out of that?
Yeah, I mean, there was that conversation I want to have, but also around the funding model that Ripple then laid into? And you said it was lucky, and you say like a lot of startups have got this model where they want to redeploy capital and from their expertise. But how can corporates? I mean, let's say I'm working in a corporate, and you said you're disrupting the very nature of what corporates are doing. What are the fundamentals that you think Ripple did in reinvesting that you think corporates need to be doing?
I think Ripple's probably a unique case. I mean, they're a private business in the US. They've been incredibly successful at doing what they do. They built this payments behemoth. But I think, I think there is corporate VC. The challenge with any corporates, and I guess in my background in payments and having worked with a lot of the banks, it's just not an environment that's conducive to startups. So I think the hardest part for them is to separate the let's fund a business, a startup doing something, from let's fund it and control it. There's always an offer of, this is what we can do for you, and hey, you can leverage our distribution. But when the rubber hits the road, like how real is that? Does the startup actually get access to that distribution or whatever it is that the corporate was offering or planning to make happen? And I think anyone who's worked in a big corporate probably knows there's just way too many decision makers, unless that's coming like on high, a decision like we're going to fund this business and we're going to give them everything they need to succeed. It's going to, probably within a year, there's going to be somebody coming in from this side that says, oh, no, they can't do that. That's like a compliance problem. We can't let them do that. Or, oh, no, we can't do that. Like, that's messing with my budget, whatever the case may be. So
I'm independent.
It is, yeah. I don't know. I'm not an expert. I don't know what the right model is, but I feel like the only way corporate funding into startups is going to succeed is if the startups are left to be startups. We have the great advantage that we can just come into work and get stuff done every day. It's not a lot of like process and procedure and red tape and worrying about like meetings. My calendar's mostly empty. I love it.
It's so funny because who was it? I think it was the CEO of ChatGPT. He said that if you try and have a meeting, you'll get fired. They don't do meetings, but they said that they're 36 times more productive than Google, and Google has got one of the highest turnovers per employee. So goodness knows what OpenAI is.
I think Google's a bit of a unicorn though. Like their business model is just like it's a cash printer, right? So it's hard to compare them to other people. They've sort of monopolized that space between them and Meta, and now they're just printing money. I heard a comment about meetings that part of the biggest problems with meetings is you come into the meeting to discuss something, and all you do is come away afterwards with more decisions to make, not less. And actually the thing that drives things forward is someone making a decision and moving on. I've got a good friend who works in professional rugby space, and we always joke is he's got this saying that's decide, delegate, disappear. So you get together, you decide what's going to happen, you delegate who's going to do it, and then as the manager or the person who's there, you need to then disappear. Let people get on with it. That doesn't happen in meetings.
It doesn't. No. I think the last thing I wanted to ask you was around, you talked about BHAGs, and there's a whole lot of thing around the customer first. And I was wondering, what's the framework that has helped you to set up this business? Because I'm used to things like scaling up by Vern Harnish. Is there anything that's sort of driven your thinking?
I wouldn't say that we have a framework. I give a lot of credit to Matt. Matt's very much a student of the startup world and businesses and so on. He's had a couple of startups of his own. So we bounce ideas off each other all the time, get a lot of help from him on this. But I think we kind of have this belief, and we're fortunate again, as I said, that we're not under time and funding pressure, which is sometimes a problem. Sometimes I think we need a little bit more urgency. Things we can get complacent, and we do have to force ourselves to up the tempo a bit. But everything's like a long-term view. So if you think about customers and we think about, what's important, is it important to get the customer off your back, the guy who's just got hold of support, and like move on to the next one? Is the goal get through the customer support as quickly as possible? Or is the goal for the customer to go away thinking, great experience, like I can't wait to, engage with Fynbos again? So there's kind of a mindset there around like the long-term investment in just delighting customers is always going to pay you back. You might not see it right now, and heaven knows, like end of the tax year, we are like bombarded. Myself, Matt, Avi are sitting on customer support, constantly. I'm not doing much more than customer support at the moment.
Okay.
And it feels very overwhelming, but we sort of, we have convinced ourselves that it's worth it because, if we have 20,000 customers who love us, that's way better than 100,000 customers who are completely kind of indifferent, because those 20,000 customers are going to refer us to their friends. They're going to bring in new customers. And that's, you look at the most successful fintechs of the last little while, Revolut, Nubank, more than half of their customers are referrals. If you just give people a great customer experience that feels authentic, as in I didn't just try and fob you off. I really care about solving your problem and care about, what do you need from us as a business? It might not scale. It's something we're going to have to continue investing in to be able to scale it. But at least, our early customers are getting white glove service, and it's kind of just been a culture from day one.
So funny because we had Rob Kuhn here a little while ago from Amazon, the Amazon CEO.
Oh, yes,
he also said he's going out distribution and handing over packets, but he also spends time in the call center. And so I said, why is that? And he said, no, you won't believe it, but actually a lot of their sticky points, they find that if someone's phoning that call center, there's a reason. So there's something going wrong in their system that's causing that. So they know that for every problem they see, that they're going to find the actual sticky point that is causing that problem. So it's helping their innovation. It's helping them to find.
We saw a study. I wish I could remember what it was, that has been very influential on how we've approached this. And it was around customer support and how it was a comparison of two businesses. And I forget the details, but the gist of the study was customer support calls were going up. So the one business just kept hiring more customer support people to handle the volume and make sure they could keep delivering. The other business looked at why and said, okay, cool. Why are we getting so many customer support queries about this issue? Let's go fix that in the product. And then that reduces the number of customer support calls, So if we see customer support as our most valuable insight into how to make the product better, not just a way to sort of deal with people and keep them happy. It's great insight for us. And it is hard because a lot of customers are going to contact support and waste your time. And, you're definitely not getting a great ROI on every single call you make. You just got to suck it up, I guess. And Matt often makes the point, we treat every customer the same. We don't, when a customer support call comes in, I can't see this person got lots of money, we better be nice to them. We just, you got to just assume every customer is the same, give them the best you can. And the goal is, again, it's long term. It's we want to be known in the industry as the place we actually get. You can actually talk to someone. You get actual support. It's not a send an email, hope for a reply within the next few days kind of thing. That's from day one, it's been just an important part of how the kind of business we want to build.
Adrian, it was so good.
You too.
I can't wait to send my money to your Fynbos account. But it's been really good, and I've learned
lots of fun. Thank you. Yeah, appreciate it. Cool. Thanks, Ralph.